Welcome everybody to the third installment in the basic investing series. Looking at the taxes here, a couple of things that come to mind is actually with these Canadian dividends getting preferential tax treatment, especially the eligible dividends here getting preferential tax treatment, that there is actually a home bias built into our tax table. A lot of financial experts say everybody has a home bias. They just think whatever is closer to home is safer. Here in this case, it's actually built into our taxes that it gives preferential treatment to Canadian companies. So something to be aware of, and know that you're being encouraged to buy at home. The other thing we were talking about was mortgage and debt and borrowing to invest and so on. And we sort of covered if interest rate is deductible, that should affect whether you want to borrow to invest. What I didn't mention was the concept of good debt. And good debt is a very personal thing. Not everybody thinks that any kind of debt is good debt and they want to be getting rid of it. I'm comfortable with debt, so I do have the concept of good debt, and I define it as something where it multiplies my earnings, my money. So if I'm able to borrow more to make even more money than just the cash that I have on hand, I consider that good debt. And conversely, bad debt is anything that's costing me money. So interest on credit cards, for example. If you're paying a 20% interest rate on your credit cards, whatever you bought with them, I hope you're enjoying it very, very much if you're not able to pay that off. And do not even consider investing before paying off credit cards, because to get a guaranteed after-tax 20% or even more return on your investments is very dubious. So pay off the credit cards and you'll get that 20% tax return or 20% return on your money. So that was that. The third thing I wanted to sort of walk you through to maybe finalize some of the ways we were looking at taxes and at the different accounts was to sort of compare and contrast. And we'll do this really quickly and then move on to new material. But compare and contrast, let's say if you buy shares in Royal Bank and compare that in an RRSP versus in a non-registered account. Okay, so let's look at a non-registered account first. So in order to buy those shares in Royal Bank, you need to pay taxes on that money first, because in a non-registered account, it's after-tax money. You purchase, let's say, $10,000 worth of Royal Bank shares, and you hold on to it for 20 years. We'll do the same thing with RRSPs until retirement. And while you're holding it, you're getting paid dividends. You have the choice of when to sell it or when not to sell it. So there's not going to be any capital gains until you sell. The dividends that you get during those 20 years, you do have to pay taxes on. You have no choice about that or about receiving the dividends. However, because it is a Canadian eligible dividend that you're getting paid, unless you're in super high tax brackets, you're paying minimal taxes on those dividends. And then in 20 years, you're ready to pull the money out. You are now gonna, let's say, get some appreciation as well. And you sell the shares for a higher price than when you bought them. And only on the difference are you going to pay capital gains. And if we look at the tax table, capital gains are the second column. So that's going to be half of the worst column. So that's kind of the best case scenario for a non-registered account where you're getting eligible dividends, so really low taxes there, and then you sell it for capital gains. Now let's pretend we bought Royal Bank shares inside our RRSP. So right up front, you are getting a tax benefit because you're buying RRSPs. So if you are in a high tax bracket, that is a good benefit to you, and it happens right up front. While with the non-registered, you pay taxes right up front. So if you were in a high tax bracket, in order to get the money for the non-registered account investment, you paid, let's say on salary, you paid fairly high taxes. So now inside the RSP, you still get paid the dividends. You don't have to withdraw them, and you don't pay taxes on them. So you're getting tax deferred growth both in the share price and with the dividends. But then in 20 years, when you're retired and you're like, okay, now I'm going to pull the money out. Here's the problem. Now you get taxed on the original 10,000. You get taxed on share price growth, and you get taxed on the dividends that you received, and all of that happens in this column. So if you're early on in your retirement and you're spending a lot of money traveling the world and you're in a high tax bracket, that's going to be deadly to you from a taxation point of view, because where you got the tax benefit, let's say on the 10,000 that you invested 20 years ago, now you're getting taxed on it. So hopefully you're in the lower tax bracket. But on the capital gains, instead of being taxed here, you're still getting taxed here. And on the dividends, instead of being taxed here, you're being taxed here. So obviously none of us know what tax bracket we're going to be in 20 years, but there, if you're putting the right kinds of investments into a non-registered account, it can actually come out ahead, or at least be pretty close to one of the registered accounts. Okay. Now, if you had an American stock instead of a Canadian one, then I'm just going to abbreviate this. Share appreciation would still be taxed here, but any dividends that American stock paid would be taxed here. So that wouldn't be nearly as advantageous for the running time of the 20 years because it's an American stock and its dividends get taxed highly. And I know I've been speaking about stocks, but you can also look at ETFs that hold those types of stocks, or mutual funds that hold types of stocks. And depending on how they're structured, you're likely to get similar results. Okay. Any questions before I launch into new material from last time, or we're starting off here? No. Okay. Cool. We talked about the scams. Okay, so let's talk about insurance. We'll talk about life insurance and disability insurance as well. So this is continuing the personal finance aspects. And so life insurance. Now, despite what salespeople tell you, you should only be buying life insurance for yourself if you have financial dependents that would suffer financially if you were to pass away. Okay. There's no reason to have life insurance on your children, for example. It doesn't matter if it's costing 50 cents a month. There's no point to it, because if the child passes away, you get paid a whole bunch of money that you didn't need, and your child is still gone. So it's sort of like, you win the lottery. If your child dies, which is morbid. So the life insurance companies do this because it's very cheap now. The risk to them is next to zero of a child passing. And when they turn 20, 21, they're just going to keep continuing with the life insurance coverage, and the life insurance company um, has a client for life. And of course, as they get older, the payments get higher, but there's absolutely no point to that. So different types of life insurance. The most basic one is term. It's only life insurance. It's generally cheap relative to what I'm going to talk about next. Premium is generally fixed during the term. The term can be 10, 15, 20, or even 30 years. If it's a short term, then the premiums are going to be smaller than if it's a longer term. And then when the term expires, you can renew, but of course, your premiums are going to be higher because you're now older. If you started smoking, God help you, your premiums are going to go up significantly. So now, insurance for somebody who's 85 years old is going to be hugely expensive. There's no doubt about that, because average Canadian lives till about 82 or so these days. And so if you're kind of past the best before date, if you even can get insurance, it's going to be super expensive. But at that point, you should not need life insurance. You should be self-insured, and your dependents should not be your dependents anymore. Your children should be adults and able to fend for themselves. If you do need life insurance, generally it's suggested that it's enough to pay off your mortgage and 10 times your salary. So that should be your benefit. So your family will have 10 years to, arrange other types of income. So that's the type of life insurance that experts recommend. However, there's permanent life insurance. That's insurance that doesn't expire. It doesn't have a fixed term. The insurance company knows that they're going to be paying out on it. So it ends up being costlier. It involves some sort of an investment. And because you have money in it, that's why it doesn't expire. But of course, you have to keep paying into it if you want the life insurance benefit. But the cash aspect of it from the investment is yours because you paid into it. It's appropriate for about 1% of the population. Whenever you hear that life insurance has an investment component, it's usually bad news. I would encourage you to really look at the numbers, and I'll show you an example in a second, and ask a ton of questions. And salespeople get significant commissions off of selling you permanent life insurance. And so they will push it really hard. And it's generally not a good thing for most people, except for that 1%. So it comes in kind of two flavors, and then there's other names for it as well. But whole life has an investing component. It allows a cash value to accumulate and lasts a lifetime. So that's why I mentioned that you generally will not be able to get term life insurance for somebody who's 85, or that it's going to be really expensive. This is how it's sold to people, is that, well, you can still have insurance at 85, but you don't want it nor need it at 85. The cash value can be accessed, meaning you can borrow against the cash value. But when it was pitched to me, I asked, what's the interest? And it was like prime +5, like it was exorbitant. It was like 9% at the time, and that was when interest rates were really low. The investments generally return really low. like 1-2% a year kind of time frame or range. Okay. Universal life is very similar to whole. Investing component, cash value. Upon death, it generally just pays the death benefit and the cash value disappears. You may need to pay an extra monthly fee, like a rider, in order to get the cash value as well. Okay, so I'm going to blow this up for you some more. So whenever life insurance, like whole life is pitched, they always give a document. I can open it up in a PDF, but this is sort of the gist of it. So that was back 5 years ago. And I said, yeah, I'll do $1,000 a month. There was a death benefit for the life insurance, completely useless to me because I don't have any dependents. But leave that aside. So I put in 12,000 a year, and the account value, and then to be honest, I don't know what the difference is between total account value and the cash surrender value. Let's use, I mean, they're not even consistently bigger or smaller. So the total account value seems to be bigger most of the time, or the same as the other one. But so after 1 year, my account value was, let's say, $10,000, and I put in 12. So $2,000 worth for a death benefit of, $250,000 is super, super expensive life insurance. Now, this was supposedly running on top of a mutual fund of some kind. And here was the assumed return of 6.25%. Later, it turns into 6.75. I'm not sure why it was calculated that way, done that way. So I was out $2,000 with a 6.25% return, and it's like that every year, right? After year two, $24,000 went in. I'm out $3,000, and that's just off of how much I paid in. Never mind the 6.25. After 5 years, if you actually do 6.25, that should be worth $70,000. It's worth 61. So I'm basically $2,000 a year went away to pay for the life insurance. Now the death benefit is increasing. Again, not that useful to me, but it could be to somebody else who actually needs life insurance. As an investment vehicle, it's not a great one. After 20 years, I would have put in $240,000. I'm sorry. And after 6.25% increases, that should be almost 476. Cash value is still 430. So now this is being sold in a couple of different ways as well. They're calling it tax deferred growth, which is true, but just like anything else, just like any investment, until you sell it, you don't pay taxes on it. So I'm not really seeing a huge benefit. It's being compared to a TFSA, which it's not. There's potential for tax-free income during retirement, sure, if you're borrowing against the cash value. Tax-free distribution of the death benefit, just like any other life insurance policy, that's true. It does bypass probate, so like all insurance. Probate, by the way, is when somebody passes away, there's a period where courts sort of certify their passing and what's happening with their assets. If there's a will, it still goes through probate, but it's usually faster. If the person had no assets, it's faster. But sometimes this is going to get pitched as basically funeral expenses or money that goes directly to your descendants, which is true, but all life insurance would do that, as would cash that you went to your child and said, listen, I'm 90, here's 20 grand, I want to have a nice funeral, and just give them cash. Just that much easier without giving the insurance company $2,000 a year. So here's a quote: the entire policy value, both the insurance coverage and fund value, are distributed directly to your heirs tax free, but not in all policies. Read the fine print, as I said, and it's up to the amount you paid in, but taxes are paid on any appreciation. So it's not actually tax free. It's just pitched as that. Now, of course, you do have some growth. I mean, not initially, right? 60,000 went in and you made 1,000. So you would pay taxes on the 1,000 if you pulled the money out. Later on, obviously, because of the time, the 20 years, you do have some taxable income. So it's just the death benefit that's tax-free, not the actual appreciation in the assets. So yeah, the death benefit of the permanent life insurance is typically tax-free, while the cash value grows tax deferred, for sure, like any other investments. That means any money you withdraw from it won't get taxed, as long as the withdrawn amount is not more than the amount that you've already paid in. So salespeople will suggest permanent insurance to pay taxes on assets. So like if you have a cottage, they're like, well, that's going to be taxed when you pass away. So here you'll have something that bypasses probate, and your descendants will have the money to pay those taxes, and they get to keep the cottage. Great. Why don't you just give them the money? Just do that. Assuming that they're responsible. Don't leave it in your estate, though. Don't have an ETF somewhere that you've earmarked to pay the taxes on the cottage, because that will get tied up in probate. So they call it being your own bank. They give it all sorts of names. It's generally not a good deal. Let me finish with that. Sorry for beating it to death, but it's just such an income sucker. If you need life insurance, get term, and then just invest the money yourself in low fee exchange traded funds. Okay. Disability insurance, that's if you're working and then you can't work anymore. They will give you ongoing payments to, let's say, replace whatever your minimum lifestyle needs are, 40,000, 50,000 a year. Because it's ongoing, it is expensive. Critical illness, if you contract one of 30, 40 different things, they'll give you a one-time payment, and then they're rid of you. That's why it's cheap, but you get what you pay for. Okay, more insurance, segregated funds. Segregated means divided or split off from. The reason they're called that is it also bypasses probate, because they are an insurance product and generally not accessible to creditors during bankruptcy. Now, I don't know how many people who are in financial trouble invest. Maybe they want to hide the money. I'm not sure. So that might be a plus to somebody. How you identify them is they usually have the word segregated in the name, and then they have kind of two numbers after the name. They usually run on top of a mutual fund. But despite what some salespeople told me, it adds 1 to 1.5% to the management expense ratio, depending on the numbers that you have after the name. It has a quote unquote maturity period, which is usually 10 years, you can get at the money anytime you want. It's just that you're not able to access the following warranties or guarantees. So the first number in my example, 75, is the percentage of premiums that you put in. So your cost that you invested is guaranteed at maturity. So if that maturity is 10 years, they're saying, well, if the stock market tanks and you put in 10 times $1,000 and it's worth $7,000, we're going to bump you up $500, so you're worth 75% of what you put in. That 75 could also be 100. They don't go beyond 100, at least not that I've seen. So it could be 100/100. So now, to somebody who's not really aware of what happens in the markets, especially if it's 100, that first number, I mean, like, this is great. I can't lose money. This is awesome. No, for a couple of reasons. One, first of all, you're losing to inflation, if nothing else. You actually need it to be appreciating. Two, you were locked in, mentally at least, for 10 years, and you were paying, instead of 2.5% MER, you were paying 3.5% or 4% MER. So the life insurance company made extra money off of you. And the worst part is that there's very, 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 very few 10-year periods where the stock market is negative. The two to come to mind is NASDAQ after the dot-com crash in 2003, where I think it took it like 15 years to get back because it just tanked because it was so high. So if you bought it at the very peak, then you would have benefited from this. If after 10 years you sold it, and they would have had to top you up some. And then the other one is Japan, which has been just horrific for decades and decades. Otherwise, S&P 500, 5 years mostly. I think I showed you in the first seminar I showed you. Basically, there's no 10-year period where the stock market is down. And if it is down, it is really just a minute amount, right? The second benefit, arguably a little bit better, is that if you pass away, the second one, in my example, 100%, is guaranteed upon your death. So if you're older and you buy this, stock market tanks, and 6 months later you pass away, your beneficiaries will be bumped up to the amount that you put in. Possibly of a benefit. The problem is it's being sold to 20-year-olds. So I'm sure they're unlikely to pass away. So instead of using these for your funeral, just give your child cash now and save yourself that extra MER, or just buy an ETF. But then, like I said, it'll get held up by probate. Okay. So that's life insurance. Usually lively debates on TikTok and elsewhere. I've never had an expert who recommended it. People who are trying to sell it, yes, absolutely. So that's life insurance. I'll move on to becoming financially independent. I think that's sort of why we're all here. You just want to be able to retire, which is financial independence. You don't have to work anymore. If you want to retire at 40, 30, whatever your goal is, right? There's a whole FIRE community, Financial Independence Retire Early, FIRE, FIRE. It's debatable, and I'll get to that in a second, whether you want to be, sitting watching Netflix for the rest of your life. If you're 30, you probably want to have something to do. Financial independence is intended to let you volunteer if that's what you want to do, let you keep working your existing job if you enjoy your existing job. It's just that you have that peace of mind that you know that you can quit anytime and you're going to be financially fine. Not for 3 to 6 months while your emergency fund lasts, then you have to get another job. Financial independence basically means your assets, your cash flow, your income has achieved a certain critical mass where it surpasses your expenses. So that's where we want to get to. So how do we get to that? One of the key things is to have several diversified streams of income. So rent, being a landlord, maybe some dividend income. If you're okay, do some contracting. If you like doing some blogging and so on, be a YouTube content producer. I wish I would count myself as in this group. I am a content producer, but haven't seen any income from YouTube at this point. You can be an online book publisher, online trainer, provider, do some online selling. If you write a book, you put the effort in, but after that, it is passive income. Dividend income, I would argue, is passive. Blogging, probably not. It's certainly not active income. I mean, you can work at midnight if you want to, and so on. Rental income, we'll talk about a little bit later, but I would argue that's not entirely passive. Online selling, I mean, I'm sure you have to do something. So, but having multiple streams of income of any kind will certainly help towards financial stability. And eventually, if you can make them passive or require minimal amount of time, you can count yourself as financially independent. So like myself, I have enough dividend income to 2 or 3 times cover my fairly frugal living expenses. So I've sort of reached that plateau. Arguably, I reached it much earlier than I actually quit my job. You wouldn't believe, though, how freeing and liberating it is to know that you can quit at any time. You actually enjoy going to the same job a little bit more when you know that you can quit anytime. So the goal would be have sufficient income from various sources to not have to work or do whatever you want to do. Like I said, if you enjoy your job, I want to volunteer at the SPCA and take care of puppies. But whatever floats your boat. It's about choices and independence and being able to take time off anytime. It means freedom, and it also means that you can quit a bad job rather than being forced to stay in it. I think the statistics show that most people tolerate their jobs and definitely would not come if they didn't get paid. Few people actively dislike their jobs. So some people want to become financially independent just so they can quit their job. I would argue you should find a better job, better career, better industry, whatever it is. Because if you're like in your 30s and you're burnt out, like you have to do something for the rest of your life. So find a job that you enjoy. I would say maybe musicians and athletes probably enjoy their jobs and would do them for free or next to free. The rest of us definitely need to get paid. So do have an emergency fund of several years of living expenses, so you don't have to sell the stocks that went down. So we talked about the bucket portfolio earlier. So that would be something to consider. Know your expenses, so you know what income you need. And then you can use the 4% rule, which basically says the amount of money you need is your yearly spending divided by the safe withdrawal rate, which is the the 4% rule. You can, of course, if you're 30, you should probably use a lower percent to retire. But so if you spend 50,000 per year divided by 4% means you are looking at 1.25 million to reach your financial independence number. The people going for FI are definitely aware of their number. I went past mine because you never know when enough is enough. In hindsight, I could have done it earlier. Years to FI is the FI number minus the amount already saved divided by yearly saving, just regular logical math. So I keep finding these charts. They have certain amount of calculations behind them, but basically it looks at your savings rate and then years till retirement. So your savings rate, of course, is how much am I living on, and how much am I do I. So if you have a 5% savings rate, you are living on 95% of your income and you're saving 5. So that's sort of how the calculations work, but it is assuming a certain rate of return, and it is assuming, let's say, a 3.5% withdrawal rate. So if you're saving 50% of your income with the assumptions, and I don't know what they are for this particular table, to be honest, that means you have to work 17 years till you retire, and then you can live on the 50% that you invested. And of course, if you are saving 100% of your income, then theoretically you're living on your passive income and you can retire now. So that's sort of how the math works. Okay. So now this is just sort of more general. This is more for retirement, obviously. Old age security, when you're looking at 65, is 15,000 per year if you lived in Canada for 40 years or more. Sorry, old age security. CPP, if you've paid into it your entire life and you've maxed it out your entire life, will pay you 15,000. So if you've lived in Canada for over 40 years, you've worked salary, and you've paid the maximum, which these days I believe is 60,000 in salary, will trigger the will have you paying the maximum. Then at 65 you will start getting 23 grand a year from those two sources, which isn't really a happy retirement. It'll keep you from living under the bridge, but I don't think anybody would want to spend their golden years sitting at home and not being able to do very much. So the reason I bring this up is you want to be saving and investing, if not for financial independence, but at least for your retirement. Because if you don't have additional money, any additional money is better than nothing. I mean, if you have 100,000 in RRSPs, when you pull the money out, it'll get taxed at next to nothing because you're very low income. And I mean, it'll pay for a couple of nice trips, for the first 10 years of your retirement. Until after that, I mean, you probably can't do a heck of a lot anymore, depending on your health. Now, if you're not getting any other income other than old age security, then you are eligible for the guaranteed income supplement, which comes from old age security bucket, but that will get you to 20,000. So if you basically have no income, the government at retirement will pay 20 grand to you. So again, not great, not something I would want to live on. Now, becoming rich, becoming financially independent, whatever you want to call it, depends, number one, on your savings rate. That's the number one determinant of what your net worth, how much money you're going to have for retirement, and so on. Second is asset allocation. Are you investing in stocks? Are you investing in bonds? Or where are you putting the money? That it's not the low fees. It's not a single stock. It's not Bitcoin. It's basically how much are you putting away and what are you putting it into? Okay. For financial independence, I would strongly suggest track your income and spending. If you don't do it religiously like I do for a decade now, do it for 3 months and then extrapolate. Make sure to include things that you pay once a year if it's outside of those 3 months. And that way you sort of know what your income is and what your burn rate is, especially. Have goals so you can pick those investments according to your time and return. If you remember the first seminar where we talked about what's your risk profile, how much money do you need, and how much time do you have. So now remember, you can't manage what you can't measure. So if you're, if you have a financial advisor even, and you go and you say, yeah, I'm going to need 60,000 a year, you're totally guessing at that. So if you haven't actually tracked your spending, you're not able to give any sort of an accurate number or use it in your calculations. But basically though, how much to save and invest, what kind of lifestyle you want to have, it's up to you. It's your life. Nobody would probably want to live the way I do. So your life goals will dictate your financial decisions. You might want to wish to live for today, right? You maybe you want to have a boat, you want to have a jet ski, you want to take 3 vacations a year. Great. That's you're living for today, which some people prioritize because maybe they don't have the foresight to know what their life is going to be like in 20 years, or that they are aware that maybe their retirement won't be gold plated, but they want to do stuff while they're young, and that's perfectly fine. So the other thing is beware of lifestyle creep as you make more money, because a lot of people will start spending more as they make more money because they think that they can afford it, they deserve it, whatever. And nice to haves become must haves. You should try not to get a raise ever again, because if you're able to live on the money that you're spending now, what does getting a raise have to do with how much money you spend? You should be investing that raise. Now, you should also determine what your goals are. Is it having time? Like I wanted time. I so much enjoy just not having to rush somewhere in the morning, a place that I didn't want to go, obviously, and then being able to go to the gym during the day when it's relatively empty. Some people want time with family. They want to have time to travel. Time is relatively free. Travel requires a little bit of time, but a lot of money. So make sure you work that into your budgets and financial plans. I do want to say, though, that people need to have a purpose. You need something to do, and it needs to be what you enjoy. So having hobbies, volunteering, that'll make you happier and it'll actually prolong your life. You can't watch Netflix for the next 40 years. I know when I was feeling really burnt out, that, having time to myself, having time to read, play video games, take a 3-hour walk in the park instead of, a 30-minute walk for the dog. I knew it sounded like heaven, but you can't fish 4 times a week and you can't play golf 7 times a week. Like eventually it wears on you. So know what you want from life, but also be realistic about it. I know having a day off sounds great when you're working 10-hour days, but once you're 6 months into it, how are you going to feel? Some people are perfectly fine. I think most people are not. Okay, switching gears, portfolio examples. This is an index ETF example. I am actually using this, or I was until recently. It's all stock ETF, so they're indexes, but following stock markets. So just as an example, I had, this is into a TFSA, so it adds up to 500, 150 into the Canadian index fund, so it covered the TSX. I had US index, 150, covered the S&P 500. I made it currency neutral, meaning fluctuations in the exchange rate between Canadian dollar and US dollar were removed. It took out an extra variable. And then I did international index because I'm sort of all for emerging markets. I was putting in $200 a month. Obviously, that's my investing thesis. I'm sure you have your own. And that was following the Morgan Stanley Capital Investments, and EFI stands for Europe, Australasia, Far East. But it's an index. So that's super simple. This is for beginners, is perfectly fine. I mention that fairly frequently on TikTok. So that's one example. This is, I think I pulled this off of Canadian Couch Potato. This is a little bit more sophisticated. So if you can't read this, it's Canadian Bond Index, Canadian Index Fund, US Index Fund, International Index Fund. So something similar to this, except you have Bond Index. And then you have the type of investor you are. So conservative, you're 70% in bonds. So again, depending on what your risk profile is and how much time you have and what sort of return you have, you would pick the different buckets. All the way through to aggressive, where you have 10% in the bonds, sort of a piggy bank, and then you have 30, 30, 30 in the three stock indexes. This one happens to be using TD's E series. You can see the E after it. They had a low MER compared to others, but other ETFs have come down as well. Oh, sorry, these are mutual funds. These are mutual funds. So there's that. These are ETFs. So again, a bond, Canada, and then rest of the world are the three. And same kind of thing, 70% in bonds through to 10% in bonds. Aggressive is outside of Canada, 60%. That would include the US and then Europe as well. So, okay, and then this was my mutual fund purchase plan that I did into my corporate account, and it was $1,000 a month, and it was international equity, tax effective balanced fund. I did a Canadian equity, and then I did a global small cap, and 300, 200, 200, 300, just as an example. It may not be right for you whatsoever. So let's look at some mutual funds. ETFs, as we talked about before, they just follow the benchmark, they follow the index. Mutual funds have a chance to actually outperform their index. So if you pick, this is referring to Morningstar, if you pick 5-star mutual funds, despite their high MERS, they will outperform other mutual funds in their category, and they will also outperform their indexes if you pick the right mutual funds. As I told you, the statistics, about 20% of mutual funds outperform their indexes, the other 80% underperform. And all the results are after the MER has come off. So it's after fees. So look for star rating, look for 4 or 5-star funds. It means it beats 70 to 90 or 90% respectively of mutual funds in their category. Look at ones that beat their index. Be aware of the MER, but it's the performance that matters. I think I've mentioned that before. Check the category so you know what the fund is investing in. And we'll talk about this in an actual example. There's something called the mutual fund load, which are additional fees in addition to the MER. They've mostly been removed, but the odd financial advisor will still sneak one in on you. There's a front-end charge where they'll charge you up to 5% upfront. It could be FE2, FE5. Deferred sales charges are a decreasing charge if you pull the money out before 7 years. It is illegal now, but I'm sure there's a ton of people who still have a deferred sales charge fund in their portfolio. It expires after 7 years. These were pushed by financial advisors who said, yeah, we don't charge you anything up front. And it's actually good for you because it prevents you from selling. It also gets them a 5% commission from the mutual fund company right up front. And then the mutual fund company makes sure that you stay with them for 7 years. So they make the money back that they paid to the financial advisor by collecting the MER. Or if you pull out early, that you pay them that charge. Low load is similar to deferred sales charge, except that it expires in 3 years, and no load, which is generally what you would get in discount brokerages when you can sell anytime. So what you would be looking for is either front end zero or no load. Okay. Okay, example. So this is a screenshot from Morningstar. It is updated as of, when was this? October 14th. So this happens to be one of my mutual funds. It is a do-it-yourself. You can see the share class is do-it-yourself. The MER, by the way, MERs tend to be higher the further from home you are, and stock mutual funds have a higher MER compared to a bond mutual fund. So this one is a global small to mid cap equity. So if this were a commission-based or advice-based mutual fund, the MER would probably be at least 2.5%, if not 3%, because not only that is it global, it's also small companies. So theoretically, the portfolio manager and the analysts will actually end up talking to the CEOs of the small companies that they invest in, and there's very little information available. If the mutual fund is investing in Apple, well, that's being covered by 100 analysts, and there's a ton of information out there, so they don't actually have to fly anywhere. So let's just go through this. So the 4 stars indicates that it's in the 30% top mutual funds in this category, which is global small/mid cap equity. If it's 5 stars, then it's in the top 10%, as I've mentioned earlier. The NAV is just the share price. Higher NAV doesn't matter. It's not better or worse than a small NAV. You're looking at the changes after you've bought it. Investment size. It's important if a mutual fund gets too big, then they're not able to make the purchases that they want without plowing in so much money that they're not able to get the low price, that as they're buying whatever they want, it starts going up in price because they are putting in so much money. So anything over 10 billion, I would start to wonder about. Sometimes the mutual fund company will close it. You can see the status here is open. Once it gets past a certain investment size, the mutual fund company will close it to new investment. This is the yield. This is the dividends. TTM stands for trailing total. Anyways, it's the dividends going 12 months, trailing 12 months. More we talked about share classes. You'll see commission-based or advice-based. Minimum initial investment is how much money you have to have with this mutual fund company per account. Investment style, so 2 dimensions to the grid here. Left and right is growth, blend, and value. So left to right is growth, blend, and values on the right. And bottom is small, middle row is medium, and top row is large or larger. Turnover is for the stocks that this mutual fund holds. How many get switched out during a typical year? So for this one, it would take 3 years for all of the assets to get cycled out and replaced, obviously. This is important if this is in a non-registered account, because if they sell something that made the mutual fund money, by law, they have to pass that capital gain on to you, and you pay for it on your taxes. So if you have a non-registered account, you would want a low turnover, and relatively 32% is actually on the lower side. You'll have ones that are 80, 90, 100 or more. So those you would want to have in a registered account. Risk level, there's three categories. There's low, second one is low to medium, third one is medium, fourth is medium to high, and fifth is high. So this one is on the high side. Inception date is important. You want to have a mutual fund that's been through something. So if it's been around for 6 months, then it doesn't have much of a history. Doesn't mean it's inherently bad. It's just that you don't know whether it's good or bad. So this one would have been through the financial crisis in 2008. So whatever returns it's had, you know that it's had at least a couple of dips behind it. One was 2008, two was 2020, and 2022, which we're sort of seeing now. So for those of you who are graphically minded, blue is the investment. You can see from the legend here. Yellow is the category, so that's other mutual funds after fees in the same category. So global small to mid cap. And then the red is the index, which has no fees. So this mutual fund is one of the unicorns. This one is outperforming its index quite handily, and it's beaten up pants off of other mutual funds. So I can totally see, looking at the yellow and the red, why people are going into ETFs, because their financial advisors are putting them into mutual funds which are badly outperforming the index. So they're just like, okay, I'm gonna just buy the index, I'm gonna pay 0.1% MER, and I'll be just a tiny bit under the index instead of buy a whole bunch. If you want to do this much research, you can find the 5-star mutual funds and look through them and look for the ones where they're outperforming their index. Now, you will note that the fact that it's outperforming its index means that it is more volatile to the upside than the index all the way up to here, and then you'll see a much bigger drop in the mutual fund than the index, and the gap here is a lot bigger than the gap today. So you basically have something that's a little bit more volatile than the index, both to the up and to the downside. Not so bad during COVID, actually. You could argue that during COVID, and you can look at it year by year as well. You don't have to get a ruler out on your screen. You could say that it actually held up pretty well during COVID compared to the index. You'll note that the other mutual funds, despite horrific underperformance, held up even better during COVID. So it is what it is. It depends on your time frame, right? We were talking about that. Here you can get year by year. This is quartile rank. You obviously want the top quartile. You can see 2021 was a bad year. It was 88th out of 100 percentile, right? So bad year, perhaps put more money in, right? That's sort of my philosophy. Okay, so to summarize, how to begin. Have an investment thesis. Please don't just start buying just random stuff here or there everywhere, okay? Have some sort of a direction. Written is even better. Have some sort of a direction, and when you're buying something or somebody at the water cooler gives you a recommendation, compare it to your investment thesis, okay? Have some sort of measurable parameters, like if you have that 1.25 million goal in 10 years, look at your trend rate upwards and say, well, looks like I need 11% a year. So you have parameters for your investments. You will get, I'm not showing it here, but you do get on Morningstar, you get what the annual return is on these investments, on these mutual funds. So if you need 11% a year, then you need to be picking mutual funds that at least historically have been in and around there. So compare all investments to this investing thesis and to this investment plan. You can choose two approaches. You can have an investing thesis that ties everything together. For example, poor countries with low average age grow fastest as people are pulled out of poverty. That's sort of mine in a nutshell. Please get your own. So you can sort of go top down, and then everything underneath it has to agree with that thesis. You can use a bottom-up approach where you pick individual investments that outperform the individual market, and they don't necessarily have to be coherently tied together. I kind of like the top-down one, which is why I'm recommending it, and that's why you can compare all your investments to this. But if you just want performance, you can aim for that. Determine your risk profile. When do I need the money? What kind of return do I need? Am I going to be able to sleep at night? And am I needing to pull money out soon in order to live on, in order to buy groceries? So am I actually going to be able to stick to my risk profile? Decide on a portfolio. Do you want to use mutual funds or ETFs? Choose a discount brokerage. Money Sense, which I do suggest. There's good reading, good articles that come out all the time. Subscribe to them. They'll give you good information. They put a best online brokers every year. It seems to be Questrade and Qtrade seem to take turns being the best discount brokerage. Check annual fees for the various accounts, minimums when annual fees are forgiven, and what no commission ETFs the brokerage supports if you do want to use ETFs. Just check on the fees and make sure you pick the one that's going to let you do what you want to do with the least amount of fees. Pick an account type. So it depends on what kind of investments you're going to want to put into it, right? Foreign dividend payers, RRSP, long shots or tax inefficient, TFSA, tax efficient, registered. You can establish all of them. I mean, RESP, you'd have to have a child or a relative that has a child. But you can create all of these when you set up your brokerage account. You fill out your forms, usually online. 12 years ago, I had to send in paper. Now it's all online, super quick, super quick. You will generally need to link your discount brokerage to your checking account to be able to transfer money in for purchases. and to transfer dividends out, for example, if you want to spend them, if you don't want to reinvest them. You may, if it's, I don't think there's any that still do paper, but you may need to send in a void check to link that brokerage to your checking account. Pick whether you want to do stocks, ETFs, or mutual funds. Again, I would highly suggest, if you're starting out, to do ETFs or mutual funds. Picking stocks is difficult, and even experts don't get it right. Fill out a pre-authorized payment form for regular withdrawals. So the mutual funds that I had showed you earlier, where it was 200 and 300, I didn't have to do anything other than have $1,000 in my checking account on the first of the month. It was super simple. Or 15th of the month, I think. Hold on, now I have to check. First of the month, right? They just pulled it automatically. They just needed, what is it? Institution number, transit number, and account number, which should be available. And if you're not doing it pre-authorized, then you transfer money from the checking account and buy your assets. So I hope you have enough information to be able to kind of evaluate these things for yourself and start if you haven't started already. Maybe I've given a few more ideas. Okay, alternate investments. So up until now, we've been talking about largely stocks and stock-based investing, whether it was through ETFs or mutual funds. Now we're going to talk about alternate investments. Stock market tends to be volatile, bond market a little bit less so. Obviously, if you want to diversify beyond the stock market, you can get into collectibles. So classic cars, if you have a 1965 Mustang, it's probably worth in the 30s or $40,000 range. A friend of mine is a mechanic, and he parked a 65 Mustang in my garage, and so getting the lawnmower out became a challenge, but it was definitely a nice car. Never took me for a ride though. Anyway, stamps is another one. Comic books, if you didn't read them. Baseball cards, if you didn't throw them around. Art's kind of a funny one to me, because it's how do you price something like that? Like, it has no utility. Sure, it makes you feel good, let's say, but how do you price it? Like, why is one piece of art worth $1 million and then another one's worth $100? Anyways, Star Wars toys in original packaging. So if you didn't play with them, real estate. Real estate is a whole big thing. I'm going to spend a little bit of time on it. I do own real estate in the US. I sold off 2 of them. A third one is in the process. Hopefully I'll get the money next week. And then 4th one is going to sell if I can help it, January 1st. Couple of things about real estate. Okay. Money's made on the buy. So we're talking investment real estate here. If it's a primary residence, other than saving you rent from having to rent somewhere else, it's a money loser. You're putting more money in. You're paying insurance. You're paying property taxes, fixing the roof, fixing the leaks, all of that. Real estate, by the way, if people think that it's a big money maker, it's not. Over the long run, it goes up at the rate of inflation. You'll have good runs like we've had for the last decade or more, which is due to the super cheap cost of money, the low interest rates. That's what's driven the prices up, and that's why they're crashing now. And in the long run, the average is going to be 3% rate of inflation, both for your primary residence and so on. Here I'm sort of going off on a tangent, so let me let me just say this. There's nothing wrong with renting. Depending on the market, if rents are cheap and house prices are relatively high, if you take your down payment and you put it into the stock market and you rent, you'll actually come out ahead. The only thing is nobody does that. People who are renting are spending all of the rest of their dollars on fun, while if they buy, well, they don't want to lose the roof over their head. So real estate ends up being a forced savings plan. Okay. Where after 20 years or 25 years, whatever, you've paid off the mortgage, the house has gone up 3 times, and suddenly you have an asset. And you're thinking, oh, real estate is great. But if you had put the money into the market, the odds are you would have done better. You can live there, pride of ownership, white picket fence, kids having a backyard, all of that stuff, but that's personal. That's not investing. Okay, so investing in real estate. Money is made on the buy, not on the sell. So what that means is you have to get a deal up front. You need to find a motivated seller, make some sort of a deal with the owner, some sort of a creative deal, something. The money has to make sense for you. This is how investors go. They phone up for a sale by owner and they say, how much do you want? They say this much. They say, well, listen, your house, in order to make the money work for me, I'm going to pay you cash, but I need it here. So you need to buy it under market price. And despite what all the gurus that are trying to mentor you out there for real estate, despite what they say, it's very difficult to find an undervalued house. It doesn't go on MLS. You don't buy it through a realtor. Once a realtor is involved, all profits are gone because it's been picked over. There's lots of houses that sell without ever going on the general market. Okay. So people will go and they will hand out business cards, or they'll say, hey, if you ever want to sell, let me know. And the thing is, somebody needs to move for work pretty quickly, or they're going through a divorce and they just want it over with, and they'd rather take a lower price rather than be stuck with their spouse for 3 months while you go through a regular sales process. And they would rather sell to somebody who pays cash and is going to get them out of there quickly. So by underpaying somebody for their property, you could make yourself feel better that you're helping them, but you definitely need a deal in order to get to make a profit. You can't force somebody to buy it from you at an inflated price. So that's why you need to make the money on the buy, not on the sell. So my properties in the US, I bought 2 of them were from banks that were foreclosures, and can't remember what the third one was, and the fourth one I bought from basically a flipper who made 10 grand just for some paperwork. Okay. So wholesaling or bird dogging is where you don't have any money to invest in real estate, but you have time and you know a whole bunch of investors and you find houses for them. So you talk to the owner, you get the house under contract. And by the way, I know this only in theory. You get the house under contract at a below market value. You need to know what that market value is. And then you phone up your list of contacts and you say, hey, I have a house. And you can either take a percentage or you just add $10,000 or $20,000 to what you're going to pay the owner, and you sell that. You basically flip it over without ever taking any possession. You flip it over to one of your investor contacts. The trick is it still needs to be a decent deal for the investor. But the investor doesn't have time or desire to go around neighborhoods and pass out business cards. So somebody's doing it for them, and then you make some money. Okay. I don't really know anybody who does that. Well, no, I do know, I do know one person who seemed to at least supplement their living. Flips. Flips, I'm sure everybody's familiar. You you buy a house, you put some lipstick on the pig, you knock out a wall, you take the moss off the roof, you put some paint on it, and you sell it for 10% more, whatever it is. The idea there is to do it very quickly. If the market's going up, it's easier. If the market's going down, it's harder, and you're likely to make less money. But most of your money comes from the value that you're adding. So you need to see that diamond in the rough. Again, underpriced, ideally, and then you add some value to it. So that's a flip. Buy and hold. So this is what I think what most people do is you buy the property, you put a renter in, and then you collect rent for as many years as you want to do it. You have to make sure it has a positive cash flow. You need to have money left in your pocket at the end of the year, not in a month, but over a year. All the expenses are included. If you want to be really diligent, you're also putting away some money for when the refrigerator needs to be replaced, when the roof needs to be redone. If you have a condo, then look at, oh my goodness, I don't have the chat open. I'm so sorry, guys. I'm so sorry. Somebody should have unmuted themselves. You guys are all typing. I hope you're all typing to yourselves. I'm so sorry. I totally forgot about that. Okay. All right. Let me finish with real estate, and then I'll go through.
We had some questions, but it's not urgent. You can look at them later.
Okay. I do apologize. Yeah, you guys aren't locked out. You guys should have anyways.
Well, I just figured you're saying stuff that's useful. I'll let you keep going. This can be answered later.
I was on a roll. On a roll. Okay. So the number one rule of rentals, it has to have positive cash flow. I cannot stress this enough. The saying is, if you don't have positive cash flow, sooner or later, you are going to lose that property. So the reason for this is, if you have a black box, you're putting some money in and more money's coming out, there's no problem, right? It's self-sustaining, depending on how much you value your time. If it's positive cash flow, $50 a month, you're not spending much time on it. You've automated everything. The renter is e-transferring you the money, no problem. Great. You're making $50 a month. It's appreciating and it's cash flowing. But if you have to kick in some money every month, no problem if you're working. But remember, real estate is a long-term game. And over 10 years, lots of stuff can happen. You lose your job, divorce, God forbid. And anything that is costing you money is the first thing that's going to get tossed overboard. And so you're going to lose that property. Real estate is a little bit more stable. It takes a little bit longer to sell. That's why it's stable. And so it's not as easy as pressing a button to get rid of it. So make sure that there's positive cash flow, and don't let somebody talk you into saying, oh, you're paying down the principal, so that contributes to positive cash flow. No, 20% down, mortgage payment is considered an expense, insurance, all of that stuff that you're putting away money for. By the way, there's online, just Google cash flow or real estate cash flow spreadsheet, and you're going to get a bunch of them. It's more of a checklist for you, actually, so you don't forget to put in, a 2% vacancy allowance, for example, as an expense, and so on. After all of that, it needs to be positive, is all I'm saying. Joint ventures. is another way to get into real estate, where you form a real corporation, or you just kind of do a partnership with a couple of people. One might be a realtor, another person contributes the money, another one does all of the fix ups and so on. And then you can say, oh, we all get a third, or it's 20, 30, 50, whatever it is. That way you can buy the real estate. I wouldn't do a joint venture for a buy and hold. Joint venture for a flip is fine, because likely it's supposed to be just a couple of months if all goes well, which it hardly ever does, by the way. So private equity. Let me finish this section, and then I'll go over the questions. Private equity is something for a little bit more advanced investors, perhaps. For some of the investments, you need to be either an eligible or I forget what the other name is. Anyways, they're eligible investors generally, it depends on the province, but net worth of $1 million and or 200,000 in income, that's that sort of thing. And it means that you're sophisticated, because anything in stocks and publicly traded, they have to make disclosures and they have to let you know about stuff. In private equity, you're supposed to be sophisticated in order to be able to read like a 100-page offering memorandum. And after that, they don't really have to let you know anything. And it's investments in companies, usually real estate related, not always. So for example, I invested in a car wash in Arizona. I gave them $20,000. They had a branch for Canadians, not of a car wash, but of the company in Alberta. And so you didn't have to do an American tax return because you invested with them, because theoretically you invested through a Canadian company. And yeah, I gave them 20 grand. They said, we're going to pay you 4 or 5% a year in cash flow. And then after 5 years, we're going to sell the car wash, and whatever money we make on that, we'll take 40%, you take 60% of the upside, you get your money back. So it's basically companies that need money, but they don't want to go public because they either don't want to disclose information to competitors, or because it's expensive to go public and they're too small. It is usually, like I said, real estate based. It doesn't have to involve real estate, but real estate, because it's seen as safer, it gives you a little bit more security, if you will. The best thing about them is that they're a diversification from the stock market. They act very differently. They're not liquid, meaning you cannot get out of them. Sometimes there's limits of how many investors they'll give money back to, or how much money they'll give back every 3 or 6 months. Others will make you pay penalties if you take your money out within 2 years. Usually these are just consider your money gone for 2 to 5 years. If they work out, they will pay nicely. I've had a couple of them go bad. One of them I'm taking to small claims court, and I'm emailing with regulators because they were a bit of a ripoff, actually. So I'm lukewarm on them. There is one, Centurion REIT, not that I'm recommending it, just saying which one it is. They have apartment buildings all over Canada. $200 on the 15th of every month drops into my checking account like clockwork. That's the one good one. They're paying out about 4% cash flow each year. And they're telling me that my share value is also going up. So if I ever want the money out, theoretically, I'll get out more than I put in. But if something goes wrong, it's lawyers and it's other people get involved, and they basically squeeze the company until there's nothing left. All the money's gone, and they're like, "Oh, well, we're done," and then you get to write off the loss. Which one of mine is that's happening with. So it's something to consider, but it wouldn't be for a beginner. And I would say no more than 10% of your portfolio should ever be in private equity. My salesman says 30%, but I don't believe him. Okay. Startups, something similar to private equity, except even riskier. I'm sure you know the idea. It's a company that has a great idea but needs money. You would definitely want to be the majority owner if you gave them a lot of money, because it's a great likelihood the company is going to go belly up. But if it ever goes public, then you'll make a mint. So that's startups. I've never done one. I've looked at a couple, but they generally didn't have really interesting ideas. Like it was derivative of something else, and you want to have something that's unique, that has the ability to differentiate that company from its competitors. Private debt can be done multiple ways. It can be done online, where you lend money to people. I hear there's a lot of fraud there where the money just disappears. So I would, if you want to do it, I've never done it. If you want to do it, I would diversify. The other way you can do it is be something called a hard money lender. That's usually for real estate development. You can charge, if you have cash, you can charge, I would say probably 10 to 15% a year. And it's usually for somebody who's doing a flip and has no money for the down payment or the renovations. You lend them the money, you make sure that you're on title, and you hope that it doesn't go to court, that they sell it after making improvements, and you get your money back. With the flips though, because the time frame is small, even though I said 10 to 15%, if it's over 4 months, for the risk that you've taken, I'm not sure if that would be worth it, but another way of making money if you have it. Commodities, I'm not much into commodities. Definitely not into gold. Silver isn't bad because at least it's used in industry, and I do have oil investments myself. You can either do it through ETFs, which would probably be the easiest way. I wouldn't do physical, obviously not oil barrels, but gold coins or silver coins, because you need to take them somewhere to exchange them for money, and they ding you. And if there's a zombie apocalypse, maybe they'll do you something. But if you just feel that you want gold, then ETF would be the way to go. By the way, gold is not an inflation hedge, nor is it stable. It's actually quite up and down, and it's more of a fear index than protection from fluctuations in the stock market. And quite often people will sell stocks and they'll buy bonds instead of gold anyways. And finally, currency. So foreign exchange, if you have Canadian dollars and you think the Canadian dollar is strong, but the US dollar is going to get stronger, which actually it's the complete opposite currently, but let's say, then you would buy the American dollar and then hope the American dollar appreciates compared to the US dollar, and then you would buy more Canadian dollars with those US dollars. There's also currency traders, which I've never done. They sort of play the same game, but there's a lot of leverage, a lot of borrowing. So it wouldn't be something I've ever done. Okay, so on to the questions. And again, I do apologize. So Daryl's saying, I've heard about infinite banking so many times, but it always sounds too good to be true. It is. They claim higher returns. Look at the numbers. So this is going back to the permanent life insurance. Lower borrowing costs? Absolutely not. I'll tell you the whole story. It was gentleman from World Financial Group that tried to sell me the life insurance I showed you the sample from. That was real. That was what he actually pitched me. And I said, but here, I'll scroll back. I said, but you know,
did you figure out the numbers? Because when he gave you the documents to sign, you could actually see the numbers there, or you made him show you the numbers before you signed?
He gave me this.
Okay. So he actually gave you something that said different.
Yeah. So it was with Equitable Life, and you know, all the reading, good stuff. And here's the table I took the screenshot of. Now, to be fair, if you already hold this after 20 years, it's still appreciating, let's say, and you're not having to put any more money in. But they've had your money for a very long time.
And if you had it instead and we're compounding it, that would probably be better for you.
Absolutely. Like these things. So when I sort of said, but hey, how is this worth 61,000 after 5 years when I gave you 60,000 in the first 5 years, you know, 5 times 12. And he's like, well, there's the cost of the life insurance. I'm like, that's really expensive life insurance for the amount of, not that I needed it, like I said, but for the amount of benefit that you're like, that's super expensive. And he goes, oh, okay, but you know, you can keep this appreciation going and you can borrow against the cash value here. And I'm like, okay, how much is the interest? And he came back like literally a week later. I don't think anybody's ever asked him. And he's like, well, it's prime plus 5. So back then it would have been 9%, which I'm just like, okay, no. And he's like, okay, but when you turn 65, then you can go to your bank and you can borrow against the cash value from the bank at lower rates. And I'm like, okay. So next time I was talking to a lender at my credit union, I'm like, do you lend against cash values of permanent life? And she's like, no, I've been here for 15 years and I've never lent anybody against that. I'm like, okay. And then I had to phone Royal Bank and I'm like, same question. They're like, yeah, none of the big banks do. None of them. I'm like, oh my God. Imagine dutifully paying into this for years and then discovering that your only choice is really just to close the policy to get your money out, and they had gotten $2,000 per year. So 16%, right? 2 divided by 12, 16% the company made off of your money. Like, no.
That's what I thought. And it's like most insurance people, I know people who work in insurance, and the guys who sell it go on the basis of they're going to say stuff that sounds really good, and it's bordering on lying, and some of them will just out and out lie.
Yeah.
Because what they say during a conversation means nothing. And then if you find out years later that they lied and you go to the insurance company says, well, this is what we got written on paper that you signed. We don't know who this guy is or what he said in a private meeting with you, but that's not what we were selling. And then they just claim ignorance, and then you're screwed.
Yeah. It's like, take him to court, but here's the documents you signed off on. So, you know,
insurance companies do that on purpose. Like, I know people who work in insurance companies and they tell me some of the shady stuff they do.
Yeah. If you need life insurance, just get term. Don't do this. And they compare this to a TFSA, and it's not a TFSA. which I hope I sort of explained. So at best, these things are a long-term, low risk. Let's say I don't know what would happen if the assumed rate of return, if that underlying mutual fund wasn't making 6.25%, if it was negative or made just a couple of percent. I'm sure all the numbers would look a lot worse. But anyways, so it wouldn't be. All right. So going back an hour, so DE was saying, so if we wanted to insure ourselves, no dependents against future disease or disability terms, no. So no, it wouldn't be. Term is life insurance. Term is life insurance. You could get either the critical illness or the disability insurance. But so I looked at, so I looked at both of these, and the critical illness one wasn't great because it just paid you once, but yeah, it was cheap. The disability was the one everybody wants, but then you're paying $200 per month in order, if you're disabled, and it's very specific of how many fingers you can lose and you know what you can and cannot do and so on. Then you get the 40 grand a year, but you've been paying a lot into it. So I'd rather take that $200 a month and I would invest it. And then as Dee is saying, what I meant by self-insured, and sorry for not clearing this up earlier, self-insured means not that you have insurance, it means that you have enough assets that you don't need insurance of any kind, that you don't need disability, critical illness, because you can live off the passive income that you have, and therefore why have disability or critical illness. And you're self-insured as far as life goes, in that you have enough assets that your dependents are going to be fine if you pass away, and they're going to be able to keep collecting the passive income from your assets. If you're not working and you're financially independent, then you're definitely self-insured. If you pass away now, your dependents are fine because they were fine up until now without you working, without you being there. So that's what I meant by self-insured, is that you don't have any insurance. It's your assets that are de facto insuring you. Daryl was saying, for me, there are jobs I would enjoy more, but they don't pay as much. My current job isn't bad, just hard. That's too bad. If I had passive income, I would take lower paying job that I enjoy more, for sure. Yeah, and going all the way through, you could volunteer at something that you really enjoy. You know, you only live once. If you can do stuff that you enjoy, we still need challenges in our lives, absolutely. It's just the one life that we have to live, we don't want to be challenged to the stress level that we have a heart attack. DE was saying, regarding several years emergency fund, save for this while working, or sell some stocks to create it prior or after retirement. I mean, that's up to you. You can certainly save an emergency fund as you go along prior to retirement. If you're a good planner and you know that you want to retire in 5 years, then to save 2 years worth of 2 years worth of spending will probably take you those 5 years. So you can sort of do it along the way. If you have some stocks that you had been wanting to sell anyways, then you can do that. Saving for it ahead of time is probably better. You can still sell the stock and either make it a 3-year emergency fund, or you can buy a different stock, right? Okay. Thoughts on self-balancing all-in-one ETFs like VGrow? VGrow is good. It's one that comes up constantly. It does have a bond component, so it's a bit less up and down. also less up, but also less down. So if you're less risk friendly, then VGrow is fine, and it becomes an all-in-one kind of an investment. If you don't want to mess with multiple investments, don't do like I did, where I have 60 stocks and 20 mutual funds. It becomes a little bit too much to keep on top of. So minimalist is definitely the way to go. So yeah, VGrow I think is a kind of one-stop shopping. Deborah was saying in your example, ETFs have some US stocks. That's okay inside the TFSA. Uh, so US stocks, whether in an ETF or alone inside an ETF, are fine. If they pay a dividend, there's going to be a 15% tax withholding on that dividend. So in that ETF, you could have stuff that pays very little dividends or no dividends, and you're good. Otherwise, yeah, ETFs in a TFSA are fine. US is fine. Yeah.
What about if the ETF is in a TFSA and you set it up so that dividends get reinvested in that ETF? Would that avoid taxes?
Well, in a TFSA, definitely.
Okay.
If you, I think for your example, if it was in a non-registered account, as soon as you get paid the dividend, you are paying taxes on it that year. It's your choice whether you're pulling it into your checking account or reinvesting it. That's up to you. So
Okay,
that
so I'd
doesn't,
still pay taxes
oh, for sure.
regardless of what I did.
Absolutely, that doesn't change the tax situation. What you do with the dividend, that was your decision, not the CRA's. Unfortunately, I get that question a lot, so it's a fairly common one. Okay, so going back, Daryl was saying my online banking shows where the information for pre-authorized payment is on a check.
Yeah,
You
that's
can,
just for everyone else. You can
for
just
sure.
look at the check and it has those three pieces of information on it. And when I log into my banking, there's like a little expand you can do, and it'll show you a picture of a check with like little underlines saying this is the transit number, this is the account number, this is the institution number.
Right? Yeah,
So
yeah,
it
yeah.
makes it very easy to figure it out.
My credit union has the same thing. Luciano was saying when I was talking about real estate, respectfully, do not agree. Real estate has not crashed if compared to ETFs or mutual funds. Um, I sure it's certainly gone down though. People expect real estate to be super stable and basically just to keep tracking upwards. And what happened in the US in 2008, which was exception because real estate was actually involved in the financial crisis. Um, Real estate can definitely go down. What we're having now is that real estate went up disproportionately because of the cheap money. So, I mean, you had years when real estate was up 20%, which is ridiculous. And now it's depending on which bank's study you listen to, it's going to go down 20, 25% in Canada. And there's arguments that Toronto and Vancouver will be worse, which would totally make sense. Certain areas apparently went up a little bit because they went up didn't go up initially. So I mean, 20% to me is a crash. That's a bear market definition. Um, it depends which ETFs or mutual funds you're talking about. Like my portfolio is down, I think about 10-15%. So I think real estate will beat that down. If you're looking at technology and some speculative stocks, they're down 70-80%. So it depends what you're looking at. But I can I think people think real estate is a little bit safer than stocks. Um, I think the main reason is that it's not liquid, that it's hard to sell, um, and it takes time. I think if people just had to press a button, then that would be a different story. But Luciano, I can see your point of view, so that's definitely something that's to be considered.
my comment was here in Montreal. I mean, at least on the outskirts of Montreal, it was insane devaluation over the last 2 years, and anyone who put money on real estate like 2-3 years ago ended up having a huge yield. And yeah, and I agree with you. I mean, depending on the funds, you could if you compare, you would be in a situation. But I have not yet seen this real estate drop in price here in Montreal.
I can say the different in Toronto. My girlfriend bought a home for 1.6 about 6 years ago. Last year, it was worth 3 million, which we thought that's great. She was planning on selling it next year. Right now, it's worth 1.1 million. So it's underwater.
Oh, jeez.
Fortunately, she's paid down the mortgage enough that it's not an issue for her. But yeah, real estate is really volatile in Toronto. It goes way up and then goes way down. My home, I bought for a condo for 500,000, and it's now worth 725.
Yeah.
Because a lot of people are selling these really expensive homes they can no longer afford and moving into smaller homes. So yeah, you never know what's going to happen. I've had years where I doubled my money in 3 years. I've had other years where I went down after like 3 or 4 years. So it's all over the place here. Maybe Montreal, we should all go there and start buying real estate.
Okay, well, yeah, great. I mean, not great as far as the price drop, but it's. I think when you look at investments, what is volatile up will also be volatile down, or can be, right? Nobody hates the upside. People just hate the downside. People think, oh, I'm a genius because I invested in this thing that did 20% in 1 year. Yeah.
But prices in Montreal were much lower, much smaller than Toronto. I mean, I think we were the only the left city here in Canada where real estate was not a bubble yet, and it became kind of a bubble recently.
Yeah, I find in Toronto though, it was just always seeming to go up, and everyone was wondering when the bubble's going to burst. And then it did once or twice a little, and so it hurt a little when you looked at the actual cash flow. But yeah, this year, oh my God, like some of those $1 million homes. And in Toronto, a $500,000 home is a bad neighborhood. I live in a bad neighborhood because I bought it for investment purposes because I knew it would flip easy. But $1 million home is not unheard of in Toronto, and most of those are down like 20%. 1+ millions are down like 30 or 40%. You get into the ones that should have been selling for 2 or 3 million, and they've cut in half here. So yeah, it goes up and down a lot, and the average home in Toronto is $800,000.
Yeah. So yeah, similar to Vancouver. So it's because money was so cheap for so long, and no. Ask to. Oh, okay. It was money was so cheap for so long. That's what drove the prices up, and they weren't going to come down. But I mean, the central bank isn't done raising interest rates yet. Tomorrow we're probably going to get 0.75% as well. So it could go down, or I think it will go down some more. But I think this kind of shows the importance of diversifying your investments as well. Because of the high interest rates, stocks got hit, bonds got hit, real estate got hit, right? So there's really no place to hide. But if you look at stock market, the S&P 500, 2019, 2020, 2021, it was all 20% or more per year gains there as well. So I think each asset class sort of has its days in the sun, and if you diversify, then something will still go down, but at least your whole portfolio won't go down. Okay, good discussion. DE was saying, is it worth using a property manager if you don't want to be a landlord? Yeah, especially if you're not local. Like I'm using property managers for myself in the US. They'll charge you probably 10%. They'll put in whatever tenant is easiest for them. They may not pick them over too much. And any expenses they charge right to you. They get the rental check, and if the plumber had to go out, the repairman had to go out, they charge you, and then they just send you a smaller check for the rent. So you still have to manage the property manager. You won't have to show the property, but they might charge you like $300 for the lease, and then they'll charge you $200 to renew the lease after a year, and they'll charge you for everything. That's how they make their money. So less work for you, especially if you're a long distance landlord. It's something that you couldn't do yourself anyways. So get a good one, check everything out. I had to fire one of mine, and then one of mine in Las Vegas ended up with 2 properties, and now he's my realtor. So it was sort of one-stop shopping and a little bit easier. But yeah, make sure you pick a good one. You'll do less work, but be under no illusion that you will do 0 work. Okay. Daryl was saying, my sister does buy and hold. I have to help her look at the numbers to see if she can have. Okay, so we talked about that one. Unfortunately, worked out poorly. Jason says, because you brought up creating a corporation, would you suggest it to pass your investments through it? No. So Jason is asking about creating a corporation just for investments. So this is a bit of a longer explanation. So corporations get low taxes on active income. So if you're running a business that's going to make over 100K and you're going to leave some money in it, then do a corporation. If you're going to buy an apartment building, not a house, I asked whether to have a corporation to hold each of my houses, and they said, no, not really. I talked to 2 different accountants. They said, no, you'll still have to insure it for fire. The only thing that'll save you is liability, that if somebody, and in the US, they're quite litigious, if somebody hurts themselves, that they can only get the house that's in the corporation. They can't come after the rest of your stuff. But they'll get the house if they hurt themselves. So just get lots of liability insurance and just keep it in your own name. So I did that. But in a corporation, passive investments are taxed heavily, Jason. So the money that you keep in the corporation should get invested, but all passive income gets taxed at the highest tax rate for that province. So dividends in BC will get taxed at 50% and capital gains at 25%. It's the way to make your money grow still, right? You still get to keep 50 and 75% respectively. But I would not go out of my way to have a corporation only for investments.
Alice, if you can excuse me, I do have one corporation, and I own real estate through the corporation.
Okay.
And you're completely right. All the income is taxed at 50%. You know, on the profit. Okay, but that's after expenses. So you can deduct, including the interest, and all the expenses are tax deductible. But bottom line, you pay 50% on your cash flow, if it is cash flowing positively, like you said.
Yeah. But if you hold the real estate in your own personal name, then you use whatever tax brackets you use, and they would be lower than 50%.
It depends on the income of the person, right? Because if you're employed and you have a high salary, then it goes on the top of your salary, right?
It would, and then it would still end up being that same 50%, but if you're not making a heck of a lot of money, then you would be benefiting because the rental income would be taxed at a lower bracket. So, yeah, no, it makes it makes sense from a liability point of view, because if you have 20 doors in an apartment building and something bad happens, then yeah, liability would be would be huge. And so the corporation sort of protects. So people will hold each apartment building in a different corporation to sort of separate things out for themselves. But yeah, whenever you're running any sort of a business, whatever expenses you have, you get to deduct them as well. So yeah, good discussion. Daryl was saying, if you are selling precious metals, most people who do this publicly sell it to someone who does it at a better rate. If you can find the company that deals with the public buyers, you can sell direct, get a decent return. I guess, I mean, if you pay lower fees for sure on the precious metals, the thing is they're just going to be volatile anyways, and you're depending on whatever the current value of that metal is. So
Yeah. I'm just saying though, if you want to diversify and you have a little extra money and you're thinking, why don't I buy like, a kilo of silver? I have had like gold, and I found like if you try and bring it to the people who you can find publicly easy, they'll often like haggle and negotiate, and they'll give you way less than what it's worth at the current market value. You might be able to get them up to like 15% what the current rate for silver is. But I found the guy who they actually sell to, and when I go to him, he says, yeah, I'll give you like 1% below market value for whatever. And when you bring him metal, like I used to bring him even like rings and jewelry and stuff like that, they melt them down, use an X-ray analysis, figure out how much of everything it is, like copper, palladium, platinum, gold, silver, and they pay you for whatever's in whatever they just analyzed for you, and then they smelter it later. So yeah, there is in most big cities a guy, and I've only found one of them in Toronto, who he is the guy who buys all the stuff from everyone else.
okay, all right, yeah. So yeah, everybody has a guy.
Yeah. So,
Uh,
and I know a realtor I was talking to, and he knows someone in Montreal who does that.
okay.
So I'm guessing, but I bet you there's probably someone in every major Canadian city who buys all that stuff from jewelers or metal collectors or metal merchants and stuff, and gives them 1% below market. And they don't even argue. He didn't even argue with me. It's just I come in and I say, here, I got a bunch of gold. He said, okay, give me a couple of minutes. Melted it all down, hit it with an X-ray, and came back and said, here's how much money it's worth. And I'm like, damn, that's like almost double what the guy at the jewelry store was going to give me.
Yeah, he's doing it in volume, and so the 1% is okay for him. Yeah. Okay. Well, good. Yes.
And he likes dealing with stores as well, or merchants who do this, because there's no haggling, there's no negotiating. He just does it, and he's always making money on it.
Okay. Yeah, I've never been a gold person, like I said, but like my mother has 5% of her portfolio in gold, but she thinks that it's stable. And again, I'll say
No,
it's not.
no. It's just to hedge against fiat currency going down, because they print more. And so I'd buy gold just temporarily if I didn't know where to put the money, because I didn't know about stocks and bonds until your webinar, and real estate moved too slow. So I'd be like, well, I can always buy gold, because I know stores that sell gold for its weight here. And then I just buy the gold and hold on to it until I could figure out what to do with it. And then when I found like a real estate deal, I'd sell the gold to this guy. I'd get the money and I'd use that for the real estate deal.
Okay. The gold though isn't an inflation hedge. Like I've read studies that say it's not an inflation hedge. It's
Okay.
I know people think it is, but statistically it doesn't seem to be. Okay, Luciano, I think we might have covered your question about the corporation and the 50%, so I'll move past that one. D was saying, if you're in prime working years, but something happens and can't work to achieve fire due to illness, disability, wouldn't your term self-insurance help cover you into old age? So, okay, hold on. We're mixing up a few things. So term life insurance, okay, is life insurance. And then you also have disability, and you have critical illness insurances, which can have different periods. Self-insurance is when you have enough assets that if you become ill, disabled, or die, nothing changes, well, for you and for the people that depend on you financially. That's what I call being self-insured. You're not paying anybody for insurance. You have rentals, and you have dividend-paying stocks and or other things that bring you cash flow. That's what I mean by self-insurance. That's what will get you into old age. Disability insurance will get you into old age because they keep paying you month after month, year after year. I'm sure there might be a limit to 65 or something like that until you're eligible for OAS and CPP, depending on the insurance. The critical illness will pay you once, so that definitely will not get you into fire or into your old age. Jason said he's 53% tax bracket. So Jason, corporation is better for active income. In BC, I think we're paying about 8% on money flowing into the corporation. And as long as it stays there, you don't pay any extra taxes on it. You can then invest it. Whatever money those investments make will then get taxed at 53 or 26%, whatever it would be in Quebec, if it was dividends and then capital gains for the lower number. Corporation is good for active income, a lot better. For passive income, not so much. Okay, perfect. Again, sorry guys, I wish I was taking these as they went along. It would have flowed a lot better if we were near the topic that you were asking about, but I think we've got caught up. Okay, so I did kind of what I think is a cool chart, where I compare based on different things, different asset types. Now, this is very much subjective. As you guys know, I'm getting out of real estate, so maybe I downgraded it a little bit more than I could have. I got this idea from a guy online who's a real estate mentor who has who helps people with their real estate investing and takes a cut and lends them money for high fees and so on. But he does a YouTube, and I'll listen to him at the gym and so on. So he did it just for real estate. I expanded it to everything. But when I finished and I compared my ratings for real estate to his, like his were all A, oh, this is great. And I'm like, yeah, maybe not. So here's what I went on. So downside risk protection from it going down. Okay, appreciation is going up. Leverage is whether you can borrow for it. Okay. Liquidity means, can you get your money out? Not the same amount that you put in, but if I decide that I want to get out of a certain investment, that there's going to be somebody who will buy it from me. Maybe not at the price that I'm hoping for, or even at the last price that the stock sold or the comparable house in the neighborhood sold, but I will find a buyer. Control, just as an owner, what kind of control do you have? Cash flow is, does it kick off some sort of cash flow? Does it pay you dividends? Does it pay you rent? Tax benefits and inflation hedge, meaning does it help you against inflation? So you can feel free to chime in. I'll keep my eye on the notes as well. You can just talk. So I'll go vertically, see how it goes. This is a recent addition. So stocks, downside risk protection, B minus. Stocks can definitely go down. 30% is sort of the worst case scenario. If it goes down beyond that, our society is going to be permanently changed. And if stocks go to zero, we're going to be in, as I keep saying, some Mad Max dystopian society. Appreciation, actually, stocks over the long run beat everything. That's just statistics. Obviously, in the short run, you can get different things. Leverage, you can borrow using a margin account to buy stocks. They'll charge you interest, obviously. Liquidity, most stocks you can get out and you'll have the money kind of the next day. Few stocks are maybe not as heavily traded, and you can get your money out, but maybe the person is willing to pay you only 10% less than the last sale happened. Control, absolutely none. You can't give the CEO of the stock that you own notes. You can vote. Maybe that's why we're giving it a C. Cash flow. If you buy the right stocks, you can get dividends. You can sell a couple of shares. You can get cash flow that way, but that doesn't really count. Okay. Tax benefits, depending on which column in the tax table we are, capital gains taxed half of salary and half of rent. And dividends can either be taxed badly or very lightly. Inflation hedge, this is a bit misleading. Stocks outperform inflation, but if there's inflation and there's higher interest rates, stocks, as we're seeing, are generally going to take it badly, at least in a short run. So you could argue that inflation hedge could be a B as well because of that. Any comments or anything is like you're way off? Everybody, does that sort of make sense? Okay. Bonds. So bonds, remember, are loans that pay interest. Downside risk protection is good, better than stocks. You could argue bonds, depending on what they are, like if it's a small company in Venezuela whose bonds you're buying, then they could do fairly badly if the company goes belly up. Generally, they're considered ballast for a portfolio. The only thing that is bad for them is when interest rates go up, which is sadly what we've had for the last year. Appreciation, generally, they're not going to be the engine of your portfolio because they're relatively safe. Same kind of leverage as the stocks on margin. You can do that. Bonds are generally liquid, I would say. Same type of control as the stocks. I can't really see you being able to phone up a company or the government. Cash flow, the interest is what you get. Now bonds are paying better yields than stocks are paying dividends. So that's why I have it as a B plus. Tax benefits, the interest that they pay gets taxed as salary, so it gets taxed in the leftmost column. Inflation hedge, bonds will lose value with inflation as interest rates go up. So I would argue they're not great in inflation, and that's what we've sort of seen in the last year. Maybe I should say I'm not a huge fan of bonds. I do have some balanced funds, which do include bonds, but I've never bought one outright by itself. Okay.
Compare bonds to cash. I mean, in a situation like we have lately, where bonds went down, I mean, I regret because my decision was to go with bonds, because I thought that would be safer, and it
Yeah,
went down and went down. So
yeah. When interest rates go up, new bonds are issued with a higher interest payment, and therefore old bonds with a lower interest payment have to be discounted, and that's why bonds went down. For the last dozen years or more, as interest rates actually went lower and lower, bonds did really well. So cash, I mean, cash has no chance to outperform inflation. Obviously, bonds are losing value because of inflation and because they're losing value. So I mean, they're even worse. Same for stocks.
but
But go ahead.
if you think in a short term, in a very short term, I mean, on the last, let's say, 12 months, if I had capped cash, I would be better off today,
You would.
and I would have a good opportunity to buy bonds at a discounted price.
You would. Yeah. When you're done with your crystal ball, can I have it? Timing is everything, and it's always so clear in the rearview mirror. Hey.
Yeah, there's so many things I did wrong and realize now it's like, damn, I had
You're
done
not
this
alone.
at that time. And so, yeah, like right now, I'm looking at what I'm going to do next year, and I'm coming up with theories based on the data of this is what I think I'm going to do in February, because I'm looking at trying to get a windfall. But who knows what's going to happen in February? Like the things I think will happen in the market by February might be completely different, in which case I'm going to have to go, okay, that's not a good plan to execute on today. Let me pivot and find some other place to put my money.
But
Yeah.
the bear market will still last a while, right, Alex? I mean, what is your opinion?
Again, it's just an opinion. Uh, like I think we're going to get into mild to medium recession, and the central banks are going to stop raising interest rates. I think they're going to raise a couple more times, especially in the U.S.
But
And
you're thinking U.S. and Canada.
yes, yeah.
Okay.
Canada always follows US. So if US raises, we tend to, maybe not as much, but we tend to follow.
Yeah, we won't. Correct. We won't raise as much. We do tend to follow. So as soon as they stop raising, I think the market's gonna take off, and then eventually it'll grind higher. It'll get used to the higher interest rates. I I mean, we would have to get into a heavy duty recession in order for the Fed to cut the rates, in which case the market would really do well. Uh, but I mean, I think timing the market is just it's impossible. It really is. Whether to get into cash or to get out of stocks, or what to do, when to put money back in. Like when I have the money, I just put the money in. In all honesty, I've said this all the way along, because we all try to time it, but it's just not really something that we do successfully. So yeah, I think that sort of speaks to your should I be in cash? Yeah, if you knew, you certainly would have been making, let's say, 2%. Due to inflation, you'd be losing 8, but you wouldn't be losing even more with the bonds. What you were saying, but
It's just that helps to share the experience, and it makes me feel a little better.
yeah, uh, I don't think anybody's gone untouched. Whether you had real estate, bonds, or stocks, you took one. But it's a buying opportunity, especially if you have money or you have access to money. And that's sort of how I look at it. I'm able to sell U.S. real estate to pay for stock purchases, but not everybody can do that. And
Would Would you take equity from real estate at this point to move to stocks?
Like I'm pretty close to maxing out my home equity line of credit on my condo where I'm living. So, but I want to pay it off. Like I don't want to sell stocks generally. I want to pay it off and then stop. So, yeah. Okay. Good discussion. And by the way, in 2 days on Thursday, there's just going to be a Q&A. We can talk more about this then if you guys want to join. Okay, so real estate is kind of the next big class. I would say it has fairly decent downside risk protection despite what happened in the US and what's happening in Canada. It's generally less volatile than stocks for sure, I would argue. It can go down, absolutely. It can go down, absolutely. Appreciation, I'm giving it a C because of the long run average being the 3% inflation. You could argue that it's higher. Obviously, the last 10 years have been an exception, and now we're sort of paying for it. But I'm giving it a C. I could have easily given it a B minus. Leverage, I think that's really the only asset class that everybody will happily lend you money for, and that's what caused the 2008 crisis in the US, where if you could fog a mirror, they would give you a loan on real estate because real estate can never ever go down, apparently. But yeah, for an investment, you can do 20%. For primary residence, you can do 5%. I know people who somewhat fraudulently will not say that it's going to be a rental and they still put 5% down, so they're really leveraging it, and then they borrowed the 5% from another property anyways. So real estate, because it's safe, is definitely considered mortgageable. Liquidity, I think it's one of the hardest ones to sell. I mean, it'll take 2 months to get a buyer in a balanced market for real estate, and then another month or more to close. And you can certainly get a home equity line of credit against real estate to get some of the money out, but if we're talking about selling the asset, I think that's more difficult. Control, you can control the renters somewhat, but you can't really control City Hall, nor the neighbors, nor the damage that the renter might do. So I'm giving it a B. I think that's probably pretty fair. Cash flow, if it's cash flowing, you'll get some. Like for some stocks and what some of the dividend yields are these days, you're unlikely to get that percentage of current value as cash flow. Like a gross, if you just go rent divided by current value, if you're getting 8%, but by the time you factor in mortgage and all the other expenses, you're probably down to low single digits. Still not horrible, I would say. Tax benefit, yes. I think as Luciano said earlier, you get tax write-offs. Rent is, however, taxed as salary. Appreciation in rental properties is capital gains. So tax-wise, I sort of averaged it out to a B. The rent, interestingly enough, I found out rent builds up RRSP room, which I would never have thought. Interesting little tidbit. But yeah, it gets taxed as salary. Inflation hedge, very, very good one. Real estate generally does well with inflation. What's beating real estate up now, of course, as we talked about, was the higher cost of mortgages and money. Any comments on the real estate column?
So rent increases RRSP. Would that be like at a federal level, or is that maybe a BC thing?
No, I think for all provinces, it's adding to your RSP limit as if you had earned salary.
Okay.
Yeah,
But dividends wouldn't?
no,
Okay.
nope.
I should make sure my sister knows that because she's got rental property.
Yeah. Well, I mean, it shows up on her assessment, so that they do it themselves. Just if you put the money, if you put the rental income in the right line on the tax return, that should automatically go into the RSP limit. Yeah. So I've been paying myself out of my corporation. I've been paying myself dividends, and my RSP limit has not budged. So. Okay, so moving on to the private equity. So again, these are small companies that you invest with directly. So downside risk protection, I might even give it a C. I might even go lower with my recent experiences. Appreciation, it can do quite well. Like I've had one where I gave them $15,000. They paid me out some cash flow along the way, and then they sold the apartment building and gave me back 25. So, and that was a couple of years. So, like the salespeople say that all in, it'll be 20% a year if everything goes well. Leverage, no, you have to borrow money from another source if like the asset itself is not leverageable. Absolutely no liquidity. Like I said, there's limits. They may not let you pull the money out for 2 years at all. They might make you pay penalties or first come, first serve as far as each quarter who can pull money out. Control, some. Funny thing is, I got to talk to a couple of the managers that were running a couple of self-storage facilities and building them. So my salesman got me in touch with them. They're just in Vancouver, so it was a phone call, and they actually answered my question. So maybe D is on the low side, but generally you won't get notifications for most of them. You're lucky if you get a quarterly email where they just tell you the car wash had this many cars and this is how much money we made and so on. Some of them give absolutely nothing. And then they give you the wrong link for the Zoom quarterly call, and I'm still waiting 2 years later for the lawyers apparently to release the notes from that quarterly call. So go figure. Cash flow, if you get the right investment, and there's different types of investments. Some only have capital appreciation. Some will pay higher cash flows, or at least promise higher cash flows. Like one was paying 12%. And that's the one that is currently in court proceedings, and all the money is going to likely be gone. So it all depends which one you choose, but let's say on the average, it's a B plus. Tax benefits. So the ones I choose, and again, you have to ask, is you pay your $10,000, they pay you cash flow, but they're giving you your own money back, or at least that's how it's on a tax slip. So your adjustable cost base is actually down, let's say down to 8,000. Then the asset gets sold, 15,000, and you pay capital gains taxes on the 7, right? 15 minus the 8. So I would argue, if you pick the right ones, that they are actually quite tax efficient. In non-registered accounts, you can put them into RSPs and TFSAs as well, where obviously it doesn't matter. Inflation hedge, maybe. I'll give it a B. Startups and businesses are going to be some extremes here. Downside is risk protection. I would argue most of them failed, which is why these angel investors, they're making sure that they have huge ownerships in the company, because if it does happen to work out, they want to really cash in. Appreciation can either be great or really bad. Leverage, absolutely not. Nobody will lend you money with that as collateral. Liquidity, probably not. You know, in 10 years when it goes public, if it goes public, then you'll get your money out. Control, what did I put for 7? Depending on whether you have controlling interest or not, you know, you could be on the board and you could be talking to a whole bunch of 20-year-olds creating apps. Like, who knows? Cash flows, I would say probably none, at least not upfront. Tax benefits, probably some tax write-offs. Inflation hedge, probably the same as private equity, I would argue. Okay. I'm sure I'm gonna get from Daryl, I'm gonna get some gold information here. So for gold, downside risk protection, I'm arguing not great. It's quite volatile. It's had a bad run for a couple of years actually, but I mean it can also have a great run. Appreciation, I would say it can go up quite well. On the average, I'm sort of thinking it runs in a range between about 1,200 and 2,100, 2,200. So that's just sort of my observation. Leverage, not really. Maybe you can buy it on some sort of a margin. Liquidity, I'm sure you can sell it, no problem. No control over the commodity, it definitely doesn't pay dividends. Tax benefits, pretty much like the other investments, you get capital gains. Inflation hedge, I made a note, it's not the inflation hedge everybody thinks it is, so I put a B minus. And then just for completeness, I said crypto. So downside risk protection, absolutely none. I personally think it's going to go to 0, but that's my my view. Appreciation, definitely. I mean, somebody who bought it Bitcoin 10 years ago is still doing quite well. Leverage, no, I don't think so. Liquidity, I think you can get your money out. I think it's fairly frequently traded 24/7 as far as I know.
Depends on which crypto. Some of it isn't traded too quickly, but the big names.
Yes.
Yeah.
Yeah, fair enough. Control, absolutely 0. Cash flow, none, but I will say there are exchange traded funds which use options, and they'll sell covered calls and maybe sell cash covered puts. So they are able to get significant amount of cash flow, but that's through an ETF and options. So for crypto itself, I would say no cash flow. Tax benefits, what did I say? Depending on whether you report the capital gains. So yeah, I mean, from a tax perspective, it could be quite good, I would say. And inflation hedge, it doesn't benefit from inflation. It just acts in a completely random fashion, I would argue. And so it could actually be a diversification. It won't go necessarily in the opposite direction of everything else. But it seemed to be acting as a risk asset more than an inflation hedge, at least for the last year. So anyways. Oh, new message. Can you touch on the dangers of options, I naked shorting / options? Yeah. So it's a little bit more advanced perhaps, but options or derivatives are contracts where you're basically making fairly short-term bets on the direction of a stock price. And I do use options myself to generate a little bit of extra cash flow. I sell puts. I can come up with the cash. So theoretically, it's not naked shorting, but shorting nonetheless. Options have a sort of a multiplier because they're short term and they move with the stock, even though you didn't have to pay the same amount as you did for the stock. So if you're right, you can make pretty nice returns. If you're wrong, you can lose all of your money, and you do have unlimited risk. So I'm gonna, for those of you on TikTok, I'm gonna do my hands thing again. So stock prices here, what I do is I sell for cash upfront. I sell a promise to buy a stock at this price. If the stock goes up, meaning I was right, this expires worthless in however long you decided to put as a date. I do 6 weeks. Now, if I was wrong, I have to buy the stock at this price. So if the stock goes down here, I'm buying something that at the time is worth here for this price. If the stock continues going down, theoretically to zero, I still have to pay the amount that I promised. So that is the danger. Unlimited risk theoretically. I don't do it on stocks that are gonna go bankrupt in the next 6 weeks. I do it on stocks you might have heard of. I'd like Bank of Nova Scotia, for example. Not that I'm suggesting it, I'm just saying. So there is definite risk there. Possibly bigger risk is stock is here and you buy a call option up here. So call option means that you get to buy a stock for this price, and you pay for that right. So if the stock goes up, as soon as it starts passing the price of the call option, the target, it's called a strike price, then you start benefiting 1 for 1. So let's say on $100 share price, you paid $5 for that call option. If you were right and it went past, you paid $5 for something that is now going to be appreciating dollar for dollar as the stock was. So you're getting a 20 to 1 multiplier. The problem is if the stock stays flat or if it goes down, your option will expire worthless and your $5 goes poof. So options are something not for the faint of heart. So DE, good. Thanks for bringing that up since I mentioned options. It's a little bit more advanced.
I didn't get how the first part works. So it's like if I buy a stock, it's currently at $10 and I put in an option put for like $5 and 6 weeks. If it doesn't go down to that in 6 weeks, it disappears?
Yeah, so okay, so stock is here currently at $100 a share. Okay. I say, you know what? I wouldn't mind buying this stock now. I would actually be happy to buy it at $90. So for a premium, I'm gonna sell a put at a strike price of $90, and I set the expiry to be 6 weeks out. Okay. I get paid right up front. I'm selling insurance. I'm selling insurance to somebody who has the stock and doesn't want to sell it, isn't sure that it's going to go down, but wants to protect themselves from it going down. Because if it goes down, they get to sell it to me for 90, even if it tanks to 70.
Okay.
Okay. And so if the stock goes up, my obligation will disappear in 6 weeks because that's the expiry date. And I would have collected whatever premium, a couple of $100, let's say, right up front. And the difficulty is if the stock goes down, meaning I was wrong, and I'm forced as it keeps going down, I'm still obligated to buy it at this price.
Okay, so the way you make money, so I understood how you lose money. The way you make money is you get a premium if things work out for you.
No, I get a premium right up front.
Oh,
I get a
oh, and
premium.
if the premium is less than the stock went down, then you end up losing money.
Yes. Yeah, but the premium isn't significant enough if the stock really tanks, like I'm still,
Right.
but the thing is, the premiums, if you annualize it, the premiums on the amount at risk will end up being like in the high teens, 20%, 30% fairly frequently, right? Because I'm making a promise and I'm on the hook for, let's say, $10,000 to buy that stock. So I do intend to do a couple of courses. One, basically what we've been doing here. Then I'm going to do one for stocks, and then I'll do a third one for options. But those are still a little ways out. So guys, we've been at this for 2.5 hours. I think we're just got financial advisors. I think that's and then that's pretty much it. So bear with me, or I'll sort of go through this quickly, and then we can continue the discussion on Thursday. So for financial advisors, they can be either bank or independent. Okay. They get paid various ways. They get paid by the commission from the sale of mutual funds. And then they get anywhere from 0.25% to 1% in fees per year, as long as you own the mutual fund. Okay. They can also be paid. This is a different way they get paid. They get paid by the transaction. So that leads to churning. So my mother's financial advisor sold one Canadian bank and bought another Canadian bank and told her that they would be better. And I'm like, I don't think there's really much of a difference, but he charged you $800 for the sell and $800 for the buy. So that's a classic example of churning, where they make money by creating useless transactions. And then you have a fee only, where they get paid a percentage of your assets. That's somewhat similar to this percentage of assets. Though the only ones that really have no conflict of interest are the ones that you pay by the hour. They'll charge you like 3,000-4,000 for a financial plan, though. So you don't want to do it with a small portfolio. Like even these guys, if you ask them, hey, should I pay down my mortgage or should I invest more in mutual funds? They're going to say invest more in mutual funds because they benefit from it. So unfortunate conflict of interest, and you need somebody with good ethical standards. They'll give you a KYC, and then at the bank especially, they'll give you a preset portfolio. Fiduciary duty means that they have to do what's best for you. So generally they would recommend exchange traded funds. Most financial advisors are just suitability, meaning I don't have to recommend the best mutual fund. I just have to recommend something that is right for your risk profile. But if it doesn't perform all that well, so be it. What you're looking for from financial advisors is they have to add value. They cannot just be salespeople. They have to. I've had multiple financial plans done and never ever had one updated a year later. So they really need to update it, because it's a projection of looking forward, but you have to update it as reality starts happening over time. They should be rebalancing and updating your portfolio. So in the first session, I talked about rebalancing, when your 60-40 became 70-30. I've had financial advisors for many years. Nobody's ever, because it's extra work for them. they should be teaching you. Most are petrified of teaching you anything because they're afraid you'll leave them. They should check on insurance. Do you have a will? Do you need a power of attorney? How's the mortgage? You know, I mean, they might check in that if they're at a bank and they'll refer you to the bank's lender, but you know what I mean. I think the highest value a financial advisor adds is they talk you out of selling when the market has gone down, and they prevent emotional decisions. If they educate you and they like recommending investments, like you could Google that and you could research on Morningstar. They really need to make you feel comfortable. And when the market's tanking, they should say, hey, listen, we talked about this. This is just what happens if you have extra money. This is where money is made. You know, and you need to trust them. You know, they don't need to be your best friend, but you do need to be able to work with them, and hopefully over a long period of time. Dee's asking, are there usually financial penalties for leaving your advisor if your portfolio is under their asset under management percent? Depends on contract you signed with Big Five bank, I guess. No. So there's a couple of things here. If you leave your financial advisor and you just take your portfolio as is to another advisor or to an independent brokerage, and you're going to run it yourself, as long as you take it in kind, and that's on the form, that's a selection that you make, there won't be any tax implications. Most of the brokerages will charge you maybe $150 for closing your account. And the brokerage that you're going to, check with them, they're likely to cover some or all of it. So leaving your advisor, definitely not. Oh yeah, Luciano, you're most welcome. Come back on Thursday. We'll talk. If your portfolio is under their assets under management percentage, so I don't know what you mean. They're not able to take a percent of money from your portfolio. It's your money. They're just managing it for you, and you're paying them indirectly commissions or possibly directly. Assets under management is just how many millions of dollars they're managing. If they have, you know, a couple of 100 clients.
Hey there, can you hear me?
Yes.
Cool. Sorry to interrupt. Yeah, I just want to clarify, like, if, let's say, theoretically, I had a wealth manager with my portfolio, right, and they're running it. Yeah, basically, if I want to do it self-investing and move it to a brokerage myself, you know, I'm going to go to the independent, let's say Questrade. I instruct Questrade, please pull my funds from this wealth advisor from their accounts. They're going to do that on my behalf in kind. But I'm just a bit worried. I guess I have to read the documents I signed still in the past about, like, is there some penalty fee that they're going to leverage against my entire portfolio?
No.
Just as a vindictive thing for, you know, moving on.
No. I've never seen it. I definitely read the documents, but no. I mean, most brokerages, like I said, $150 per account that you're closing. As long as you're pulling it in kind, you're not selling anything, you're not deregistering your RRSP or anything like that. There shouldn't be anything else. They can't, oh, you know, you're leaving, I'm gonna charge you $50,000. That's not a thing. I wouldn't be worried about that.
You've never heard of such a case. Okay, that's good.
No.
Thanks.
I usually think the $150 is vindictive enough, but maybe that's just me. But like I said, if you go to the right brokerage, they'll cover it. Like I just transferred my TFSA from Qtrade to Wealthsimple, and Q-Trade charged me $150, and at Wealthsimple, I just answered a couple of questions and they credited me for that. So no problem that way. No, they don't take anything that way. I wouldn't be worried.
Cool.
Okay, not tax. Okay, when you close, yeah. So I think we answered that. What you should do is you should compare your investment performance to its benchmark, not just whether you made money or lost money. So here's a scenario: some client walks into the financial advisor's office, and the financial advisor says, "Hey, great, you made 15% this last year," and the client's like, "Oh, yeah, that's great." Or the financial advisor says, "Hey, listen, you lost 5% this past year. Market's been kind of bad," and the client's like, "Boo!" But that's just the absolute return. What you should be asking to evaluate whether the financial advisor is doing a good job is, what did the overall market do? So in the first situation, if the market did 20% and you made 15%, you're like, so why are you underperforming your benchmark? Now make sure it's the right benchmark. Like, don't compare Canadian mutual funds to mutual funds that invest in the US, for example. But in the second situation, it's like, oh, you lost 5%. Okay, what did the market do? Well, the market lost 10%. They're doing a great job, right? Because next year it'll go back up. So it's kind of that second level of analysis for financial advisors. Deborah was asking, a non-registered can be done in kind with no tax implications. Anything that you can transfer in kind has no tax implications. In a non-registered, if you sell it, even if it stays in the account, that has a tax implication. You'll get a capital loss or a capital gain. In an RRSP, you can sell something as long as it stays in the RRSP account. There's no tax implication. It's only when you pull the cash into your checking that you that counts on your income for that year. But if you pull it over in kind, no tax implication on anything.
So just a quick on that one. If you move stuff from a non-registered to another non-registered broker, let's say from whatever, Scotiabank to Questrade, but Scotiabank had you in proprietary funds, it's going to automatically sell when it goes to Questrade because they don't exist there, those funds.
Yeah, so okay, fair enough. If it's something that the brokerage that you're going to doesn't support, then yeah, then they would you would probably select, or they would do it for you automatically. They would transfer it to cash. They would transfer it as cash, and then that would be a taxable event at that point. Yeah. What you can do is get your, well, no, I mean, even if they did it, even if Bank of Nova Scotia sold it for something that Q-Trade could or Questrade could handle, there would still be a tax implication on that sale in a non-registered account. So yeah, so that kind of sucks if it is something proprietary. You'd be surprised how many different mutual fund groups and so on these brokerages handle. But if it's something that's only Bank of Nova Scotia, well, like earlier I showed you guys those E-Series mutual funds. I'm gonna scroll back. Yeah, these E-Series here, those used to be only for TD. They were sort of a loss leader. They had really low MERS, so people try to get you to, but you could only buy them if you got your brokerage account with TD, and then of course your checking account and your mortgage followed. So they were a loss leader, and now you can get them on any brokerage. So things progress, let's say. But if it's something proprietary, then that's you might be out of luck that way, and there'll be a tax implication.
So you should plan this with your accountant before you move stuff. What's the best way to deal with this, right?
Yeah, well, only if you have a gain. That would be the only time I'd be worried. If you have a loss, then you can actually use it to offset a capital gain somewhere else. So if there's something else that's tanked and you don't believe in it anymore, then you could sell that and then offset the capital gains from this proprietary thing. So if it's the same fund, just a different series, I'm trying to remember whether switching series is a taxable event. I can't remember, Deborah. But yeah, so DE, sorry, I got away from you. I would say plan it with your accountant. But I mean, if you made money, I mean, moving the account, you can't really split over a couple of years or anything like that. They might become suspicious if you say, hey, December 31st, can you convert half of this to cash? And then January 2nd, can you convert the other half to cash? Like it,
Yeah. And also the question of ACB, I think it is. So you should probably download a report from the current broker of the cost basis for everything.
Yeah.
Because once you transfer it out, you don't have access to that anymore, right? And it starts as net new or something in the new brokerage. I don't know.
Yeah, you know what? I think for mutual funds, I seem to remember when you transfer mutual funds that the ACB goes along with them. But I transferred a bunch of stocks, individual stocks from Q-Trade into Interactive Brokers, and they made me enter all the adjusted cost bases because they said we don't get them, which I was shocked and disappointed. So ultimately, and they also told me this, Interactive Brokers did, they said it's your responsibility to report the right numbers to the CRA because you're the one paying the taxes. And if you don't pay the taxes, then you're the one that they're going to come after, which I think really sucks. So yeah, I mean, plan it as best as you can. Definitely check phone Questrade or whoever you're planning on going to, and before doing all the planning, see whether they're able to take. You might be surprised, and they might be able to take it. Does that answer your question?
Yeah. I'm going to speak to the accountant and say, what do you need? Because I'm not an expert with all that stuff with the ACB. So I'll say, what do you need from the current broker if I'm going to transfer this out? And let's assume that it starts fresh at the other one for tracking. So what does he need to work this going forward?
Yeah, that's a good way. I don't think the account just disappears. You may not be able to log in, but they should send you a final statement with everything being zeros. As far as, I mean, even take screenshots or export whatever you have now and but I mean, it should show up in the statements. The statements might be 5 years ago if that's when you bought it. I track everything myself in Quicken, but I know not everybody does. Okay, so what if it's the same fund, just a different series? I think, yeah, I'm not sure about the series, Deborah. I'll give them a call and find out. Regardless, this is a good time since it's lower. Yeah, I mean, I've sort of taken the view of paying taxes. If I'm paying taxes, that means I made money. Nobody likes to pay taxes. I looked it up and I paid 40K last year in taxes. So that hurts, but it means that I made some money somewhere. When I track my assets, it's obviously the gross value. With a TFSA, it's accurate. With real estate, it's tax efficient, but I will pay some taxes. And with the RSP, I'll pay a whole bunch of taxes. So tracking things, obviously you can't track it with taxes because you don't even know what tax bracket you'll be in when you pull it. But yeah. Okay, so moving along swiftly. So great financial advisors will not just pick mutual funds for you. You can do the same thing yourself, perhaps better. They should get all your life together and show you blind spots and problems. They should know your life fairly well. I mean, if they have 600 clients, that might be a little difficult, but and they should point you to what's important in the huge amount of web info. They should tell you to do nothing during crashes. They should make you stick to a plan, reminding you why it's important and what the plan is. They should do risk management and say, I think you're too exposed here or there. Help you with a budget. Maybe financial advisor will go to that length. I don't know one that would, but ensure that you're saving into the right account types and that they have some idea about taxes. They know how you're planning on taking the money out later. They should at least have a working knowledge of the tax laws, point out opportunities, point out weaknesses, look at the big picture for you. Rebalance your portfolio, and then prevent those emotional investing decisions, usually with fear. And you should be willing to pay for great advice. Like when I was working in IT, anytime I was working, I wanted to get paid. Financial advisors do deserve to get paid. I don't like it when a financial advisor from a bank says, you don't pay me, because that is super misleading. You pay the MER on the mutual funds that they sell you, and then the mutual fund company pays their bank, who will then pay their salary and some bonuses. Robo-Advisors, you fill out a know your client to get the risk profile. It's 20 questions. That determines a portfolio for you, predetermined, one of 20 usually. Advisors automatically gonna keep the portfolio for you and rebalance it for you, so you don't actually have to do that. It's not a huge amount of work to rebalance a portfolio, especially if you have 3 ETFs or something. A portfolio is low fee ETFs and index funds, so it's similar to the couch potato portfolio I showed you up above. And they will also charge you a percentage of assets. It will be like 0.5% instead of probably 1% that a human will charge you. You're still paying the MERS on the ETFs though. So like everybody wants to get paid. Okay, home stretch. Even if you have a financial advisor, nobody's going to take as good care of your money as you. I always cringe when people say, I don't want to know, I don't care. And I'm like, you spent so much time at work making the money to invest, and then you're blindly giving it to somebody and you don't even know what questions to ask them. So I think educating yourself, I think is the way to go, and knowing what to ask and what not to ask. Okay, so home stretch here, information, morningstar.ca, a lot of great articles, a lot of great research. They don't have ETFs on Morningstar, at least not the Canadian one. Stockchase.com is good for stock and ETF research. Somebody listens to BNN and CNBC, and when one of the talking heads is talking about a specific stock or an ETF, somebody dutifully types it in accurately, by the way, and you can look it up by stock So if you're looking to buy something, you can see what the experts have said going back 5 years. Money Sense, I had mentioned previously, it's personal finance articles, investing, couch potato portfolios. They used to have a paper magazine. They're entirely online. Couchpotato.com, low cost portfolios. There's some articles, not my everyday reading, but it's a Canadian site. And Bean and Bloomberg, I watch videos every day of what they put up there. And last is a couple of books to read. Automatic Millionaire is a good one. Basically, how to automate things. David Bach also coined the term the latte factor, where instead of buying something for $5 every day, he used coffee as an example, but that's a metaphor. If you instead invest it and you automate it, you will be a millionaire. Rich Dad, Poor Dad. I'm not a huge fan of Kiyosaki. He does have a couple of good ideas. He likes real estate, didn't seem to like stocks at the time. 20 years later, he likes Bitcoin. He basically says whatever makes you money is an asset, whatever loses you money is a liability, which I think is a great way of looking at things. So a car, unless it's a taxi, I know it's on the asset side of the balance sheet, but it's a liability. It's costing you money and depreciating on top of that, but saving you time. So if you can use your time better, anyways. And the other thing is, he defines wealth as how many years you don't have to work, which is sort of bringing into somebody who makes a lot of money but spends a lot of money, and they're out on the street in 3 months if they lose their job. Wealthy Barber Returns, good reads, nothing sophisticated, but in a very palatable, kind of nice story kind of format, basic investing and personal finance information. Millionaire Next Door, famous one, kind of a personal finance thing as well. Spend less than you make. And sometimes the person who looks the poorest is the richest because they didn't spend a lot of money to look rich. While somebody driving a BMW in a $5,000 suit could be up to their eyeballs in credit card debt in order to support the lifestyle and impress people that may not care.